Okay, picture this. You're an NRI, living abroad, maybe for quite some time, and you find out you've inherited the old family home back in India, or perhaps some shares your parents held onto.
Mm.
And suddenly your mind's racing, right? What does this mean financially, especially when it comes to Indian taxes? It can feel pretty overwhelming from far away.
Absolutely. It's a really common situation. And, understanding the tax side of things early on can prevent a lot of stress, maybe even unexpected cost later.
Exactly. So that's what we're tackling today, a deep dive into capital gains tax in India, specifically for NRIs dealing with inherited assets. We want to clear up when tax applies, how you calculate it, and, well, the crucial things you need to keep in mind.
Sounds good.
And hey, if this topic resonates with you, please give us a like and definitely hit that subscribe button for more insights like this one.
Right. So let's jump in. The big question first. You inherit something in India. As an NRI, do you immediately owe tax just for receiving it?
Yeah, let's get right to that. Property, shares, bank funds. Does the act of inheriting itself trigger tax?
Okay, so the good news here is no. Simply inheriting assets, whether they're movable like shares or bank deposits, or immovable like a house, doesn't attract capital gains tax in India at that point.
Here. Okay.
The tax law specifically says that transfers through a will or inheritance aren't treated as taxable transfers.
That's a really important baseline. So just getting the asset isn't the taxable moment. But of course, it's not always that simple. When does the tax picture actually change?
It changes when you, the inheritor, decide to sell that asset. The sale is the event that can potentially trigger capital gains tax.
Okay, the sale.
Yeah.
That's the key. So how do you even start calculating the gain if you didn't buy it yourself? What's the starting point, the cost?
Yeah, that's where it gets a bit different from buying an asset directly. For an inherited asset, the cost of acquisition for tax purposes isn't zero, and it's not its value when you inherited it.
Right.
It's actually the cost that the previous owner paid for it, the person you inherited from.
Okay, so you need their purchase details. What if they bought it, say, decades ago, before 2001?
Ah, good question. If the asset was originally acquired before April 1st, 2001, the rules give you an option, which can be quite helpful.
An option.
Yes, you can choose either the actual cost the previous owner paid, or you can use the fair market value, the FMV, of the asset as it was on April 1st, 2001, whichever is higher, usually.
Interesting. So using that 2001 value could potentially lower the taxable gain if the property appreciated a lot before then.
Exactly. It can be a significant benefit, but you'd need, a proper valuation report for that FMV.
Makes sense. Documentation is key. Now, what about the holding period? Does the time the previous owner held it count towards whether it's a short-term or long-term gain for me?
It absolutely does. The holding period includes the time the previous owner held the asset, right up until you sell it.
So it's combined.
Yes, combined. This total period determines its long-term or short-term. For things like listed shares or equity mutual funds, holding it for more than 12 months makes it long-term. For other assets like property or gold, it's generally more than 24 months.
Got it. So inherited assets quite often fall into the long-term category then. Now, indexation adjusting the cost for inflation, how does that apply to NRIs selling assets now? I heard there are changes.
Yes, this is a really crucial point, especially recently. For NRIs selling land or buildings on or after July 23rd, 2024, the benefit of indexation is generally not available anymore.
Oh, wow. So that inflation adjustment to the cost basis is gone for NRIs in most cases now.
Broadly, yes, for land and buildings sold after that date. There is a bit of an exception for resident individuals, or HUFs, selling property they acquired before July 23, 2024. They get an option to calculate tax with or without indexation, choose what's better. But for most NRIs selling now, indication is off the table for those assets.
That's a significant planning factor for NRIs thinking about selling inherited property. So, quick example. Dad bought a house in 98, you inherit it in 2020, sell late 2024. What's the summary?
Okay, sell in late 2024.
Mm.
Cost basis. What Dad paid in 98, or maybe the higher FMV from April 1st, 2001, if documented. Holding period. Long term from 98 to 24. Indexation. As an NRI selling after July 23, 2024, likely no indexation benefit.
Right, really highlights needing those old purchase documents or that 2001 valuation.
Definitely. Proper records are vital. The will, succession certificate, original purchase deed, maybe that valuer's report.
Okay. What about inheriting listed shares or equity mutual funds? Anything special there?
Yes, there's a specific rule called grandfathering that applies if you inherited listed shares or equity fund units and then sell them on or after April 1st, 2018.
Grandfathering sounds like it protects something from the past. How does it
Right.
work?
It affects the cost calculation. For these assets, the tax law sets a deemed cost of acquisition.
Deemed cost. What does that mean practically?
It means your cost isn't just what the previous owner paid. It's calculated as the higher of. One, the actual cost of the previous owner, and two, the lower of these two figures, the fair market value on January 31st, 2018, and the actual sale price you get.
Okay, bit complex. Higher of A and lower of B and C. What's the point of that calculation?
The main goal is to effectively exempt any gains that built up before January 31st, 2018 from being taxed when you eventually sell. It sets a sort of baseline value at that date.
Got it. Could you run through a quick numbers example for shares?
Sure. Let's say your father bought shares in 2012 for, say, 75 rupees each. On Jan 31, 2018, their FMV was 180 rupees. You inherit them in 2023 and sell in 2025 for 220 rupees.
Okay.
Your deemed cost is the higher of dad's cost, 75, and the lower of Jan 2018 FMV, 180, and sale price, 220. So the lower of 180 and 220 is 180. The higher of 75, 180 is 180.
So the deemed cost is 180.
Right. Capital gain is then sale price, 220, minus deemed cost, 180, which equals 40 rupees per share. That's what's taxable.
That clarifies the grandfathering rule nicely. Okay, nearly done. Just a very quick word on double taxation avoidance agreements, DTAAs. Did they play a role here? Maybe 15 seconds?
Yes, briefly. If you, as an NRI, are a tax resident in a country that has a DTAA with India, you might get some tax relief under that treaty for games made in India.
Might.
It really depends on the specific agreement between India and your country of residence and your personal situation. It's not automatic, so it needs checking case by case.
Okay, something to be aware of and potentially look into. Right, so wrapping up, dealing with capital gains on inherited assets in India as an NRI clearly involves understanding quite a few nuances when tax hits, the cost basis rules, holding periods, no indexation generally now, and special rules like grandfathering.
It's a lot to track.
It really is. And for advice tailored specifically to your situation, we absolutely recommend reaching out to the professionals at Tax Acceler. They can help you navigate the details.
Yes, personalized advice is often essential here.
And you can also check out the AI-powered chatbot on the Tax Acceler website for some initial guidance on your queries. It's a great starting point.
Good resource.
And finally, if you found this deep dive helpful, please do remember to like this video and hit subscribe for more crucial insights for NRIs. The key takeaway: be proactive, understand these tax rules, and manage your inherited assets wisely for your financial peace of mind.